In this week's market update, earnings season starts to shine a light on how COVID-19 will hit profits. The pre-Easter market rally holds for now, but oil fails to respond to big cuts in global production. Investors returned from the long Easter weekend in good spirits, with markets holding on to the gains they'd secured in recent weeks. Shares across Asia and Europe gained further ground as evidence started to emerge that the worst hit countries are looking to life beyond the lockdown. In the US, the S&P closed up another 3% last night. In particular, investors welcomed a lower than expected fall in Chinese exports in March. The 3.5% reduction during the month compared with much sharper declines in January and February as the country led the world into the corona crisis. The UK was a notable exception to this trend, with no sign of an end to the country's forced isolation, which began 3 weeks ago. The death count, meanwhile, rose to the biggest weekly total in the 15 years that comparable figures have been collected. 16,000 deaths were reported in the week to April 3rd, around 6,000 more than the average over the past 5 years. In addition to the human cost, the economic price tag is also rising. According to the Office for Budget Responsibility, the country's fiscal watchdog, the UK economy faces a 35% drop in output in the second quarter if the lockdown were to remain in place for the full 3 months. Even assuming a partial return to activity in the following 3 months and no permanent damage to the economy, GDP could fall by 13% on an annual basis in 2020. That would be far worse than during the financial crisis of 12 years ago. The OBR also warned that the government's budget deficit would rise to 14% of GDP, twice the level reached in 2008, and the worst reading since the Second World War. The UK data chimed with forecasts from the International Monetary Fund, which yesterday said that the global economy faced its biggest slump since the Great Depression, dwarfing the downturn that followed the 2008 financial crisis. The IMF said that it expected developed economies to contract by more than 6% in 2020 and the developing world by 1%. Despite a rapid recovery in 2021, it's expected that the developed economies will be 5% smaller at the end of next year than the IMF had forecast when it made its last predictions in October. Unemployment in the US, where hiring and firing tends to be most dramatic thanks to its flexible labour laws, is expected to rise from 3.7% to 10.4% by the end of this year, and to fall only slightly to 9.1% next year. Overall, global growth is predicted to fall to minus 3% compared with the IMF's January forecast of plus 3.3%. By comparison, in 2009, the worst year of the financial crisis's economic impact, global growth fell by just 0.1%. The gloomy outlook came as Europe's hardest hit economies, notably Spain and Italy, said they were moving tentatively to reopening for business. Although in France, President Macron announced a further extension to that country's lockdown until May the 11th. While the macroeconomic data paints a gloomy picture for whole countries, what matters to investors is the impact on corporate earnings and how quickly companies regain their previous levels of profitability. The spotlight will start to shine on the corporate outlook from this week when the US earnings season gets underway as usual with results from the big banks. Yesterday, JP Morgan said that first quarter profits fell by 69% as it made significantly larger provisions against loan losses. The fall in profits marks a dramatic turnaround for the bank, which 3 months ago announced its biggest ever annual profit. Jamie Dimon, chief executive, referred to the likelihood of a fairly severe recession this year, a reversal of his position last year when he told analysts that growth could go on for years. The recovery in share prices in recent weeks is likely to look increasingly at odds with the reality of economic, corporate, and medical headlines as job losses mount, profits fall, and the death toll continues to rise. Looking through the current headlines to the recovery beyond is what stock markets do, of course. The only question is whether investors are too optimistic about the scale and speed of that recovery. On March the 23rd, the S&P 500 stood 35% below its February the 19th peak. but it's currently just 18% lower. The bullish case rests on government and central bank stimulus, both monetary and fiscal, being able to bridge the gap between the downturn and the rebound. The near unlimited power of the authorities to step into the breach was confirmed last Friday when the Federal Reserve offered up a further $2.3 trillion of firepower. In particular, the Fed's willingness to buy corporate bonds has increased investors' willingness to take on the risk of owning company shares, which come lower down the pecking order than bonds and so are protected by a backstop for company debts. Support for one important sector of the economy, energy, was also provided by an agreement between the world's oil producers to cut production and so boost the oil price. The slump in the cost of crude from over $70 to as low as $20 recently put the future of many heavily borrowed oil companies at risk. The deal, struck at the weekend after 4 days of talks, sees the so-called OPEC Plus group of producers promising to reduce output by nearly 10 million barrels of oil a day, about 10% of global production. Contributions from other producers like the US, Canada, and Brazil could see the total fall in output reach 15 million barrels. What's perhaps surprising, given the scale of the proposed cuts, is the market's relatively modest reaction to the deal. The price of Brent crude remains at around $30 a barrel, as traders bet that even these measures will not be enough to counter a near 30% fall in global energy demand due to lockdowns, shuttered factories, and grounded aircraft. There's also considerable skepticism about compliance with the proposed cuts, a perennial problem for an industry which has been likened to herding cats. And the fact, too, that the cuts are time limited, with the biggest cuts only due to last until June. Although the current market volatility has created challenges for investors, it's also creating plenty of opportunity too. Although few have managed the roller coaster with as much skill as Bill Ackman at the Pershing Square hedge fund, who unveiled a $4.6 billion profit from credit default hedges, which he took out in February, largely offsetting the fall in value of the fund's long positions and enabling him to buy in at the end of March to take advantage of depressed market prices. What's clear from the recent market turmoil is that a huge gap has opened up between the market's winners and losers. The dispersion between the best and worst performing sectors in the S&P 500 reached 47% in March, according to S&P Dow Jones data. That's the widest since at least 2005. Energy equipment was the worst performer, down 57% as the oil price collapsed, while telecoms and healthcare stocks fell only about 10%. Overall, the S&P 500 fell 12.5% in March, although this was flattered by the high weighting in the US index of tech stocks, which held up much better than average. One of the clear winners from the corona crisis has been Amazon, which said this week that it would be hiring another 75,000 staff, despite already adding 100,000 last month to meet soaring demand for its home delivery service. Other high-profile beneficiaries have been the supermarkets, with Tesco coming in for criticism last week after announcing a higher-than-expected dividend, despite accepting a business rates holiday from the government in line with other companies. And finally, in other assets, house prices are set to fall by as much as 13% on average in 2020 in the UK, as the market grinds to a halt due to social distancing measures, making it impossible for potential buyers to view properties. Activity is due to fall to a 20-year low, putting an end to the nascent recovery in house prices from the stagnation that followed the Brexit referendum in 2016. And gold, meanwhile, continues to find safe haven buyers as the precious metals price rises above $1,700 an ounce. In the past 18 months, gold has risen from below $1,200 as investors have warmed to its ability to hedge against a range of economic ills, including both inflation and deflation.